In America, the price on a house is not the price you pay. The listing may say $400,000. The mortgage calculator may show one monthly payment, but behind that number is a second bill, interest, closing costs, property taxes, homeowners insurance, and sometimes PMI, HO dues, repairs, and an escrow shortage that can raise your payment later. And in 2026, that second bill matters more than ever. The median existing home sold for a record $440,600 in June, while the average 30-year fixed mortgage rate reached 6.69% on August 6th. In this video, we will decode the real cost of an American mortgage compared to the last 5 years. Show how inflation and higher rates change the math, uncover the charges most buyers miss, and finish with a practical playbook to help you shop, negotiate, and protect your budget. Start with the market people are walking into right now. In June 2026, the national median existing home price reached $440,600, up 1.8% from a year earlier. Existing home sales fell 2.4% from May. Pending sales also dropped 5.4% in June as buyers faced the combination of high borrowing costs and record prices. This is not a simple story of prices rising everywhere at the same speed. FAFA's broader house price index showed national prices up 2.2% year over year in May. Local markets can move in very different directions. A national median is a map legend, not your street. But one pressure is national: the cost of borrowing. Freddie Mac's average 30-year fixed rate was 6.69% on August 6, 2026. That rate is not the Federal Reserve's overnight policy rate, and the Fed does not directly assign your mortgage rate. Mortgage pricing responds to the bond market, inflation expectations, lender costs, borrower risk, loan type, and other factors. The two rates influence each other, but they are not the same dial. Now put the current numbers together. Take the June median price of $440,600. With 20% down, the loan would be $352,480. At 6.69% for 30 years, principal and interest alone would be about $2,272 per month. That is only the visible payment. It does not include property tax. It does not include homeowners insurance. It does not include HO, maintenance, utilities, or the cash needed to close. The biggest mistake is asking, can I make the mortgage payment? The better question is, can I carry the house? Let us open the bill. The first hidden layer arrives before the first mortgage payment: closing costs. The Consumer Financial Protection Bureau says they typically run 2 to 5% of the purchase price, excluding the down payment. On a $440,600 home, that range is roughly $8,800 to $22,000. Your real number may land outside it, but it shows why I saved the down payment is not the same as I have enough cash to close. Those costs can include lender charges, appraisal and credit fees, title services, government recording charges, prepaid interest, and initial tax and insurance funding. Some items are negotiable or shoppable. Others are controlled by a government, settlement provider, insurer, or the date you close. The second layer is interest. At our illustrative 6.69% rate, the first $2,272 principal and interest payment sends about $1,965 to interest and only about $307 to principal. That is normal amortization, not a surprise fee, but it surprises people because the early balance falls slowly. If that exact loan stayed in place for all 360 scheduled payments, Total interest would be about $465,500. Real borrowers may sell, refinance, prepay, or miss payments. So this is not a prediction. It is the cost of following that payment schedule to the end. The third layer is escrow. Many servicers collect part of your property tax and insurance bills every month. If those bills rise, your escrow payment can rise if the account has a shortage. The servicer may collect more to repay the shortage as well as fund the new estimate. This is how a fixed-rate mortgage can still produce a changing total monthly payment. The interest rate may be fixed, but the house expenses are not. Then comes homeowners insurance. A mortgage lender generally requires it, but standard policies usually do not cover flooding. Treasury found that average homeowners premiums rose almost 20% between 2021 and 2023, with double-digit increases in some states and serious availability problems in higher-risk areas. That is why an insurance quote belongs in the offer stage budget, not after inspection, and not 3 days before closing. Next is private mortgage insurance, or PMI. On many conventional loans, it is commonly required when the down payment is below 20%. Me protects the lender, not the borrower. It can help someone buy with less cash up front, but it adds to the monthly cost. Under federal rules, eligible borrowers can generally request cancellation when the principal balance reaches 80% of the home's original value, subject to conditions. Finally, there are costs no mortgage disclosure can perfectly predict: HOA assessments, utilities, appliances, roofs, plumbing, deductibles, and maintenance. A lender's approval answers whether the loan meets its rules. It does not certify that the home fits your life. To understand 2026, go back 5 years. In the first week of August 2021, Freddie Mac's average 30-year fixed rate was 2.77%. In the matching week of 2022, it was 4.99%. Then 6.90% in 2023, 6.73% in 2024, 6.63% in 2025, and 6.69% in 2026. Now hold the price and down payment constant so we isolate only the rate. On the same $352,480 loan, principal and interest at 2.77% would be about $1,443 a month. At 6.69%, it is about $2,272. That is roughly $829 more every month, or almost $9,000. $950 a year caused by the rate difference alone. Real households face both rate and price changes. CFPB research found that the principal and interest payment on a median priced home with 5% down increased $1,532 or 113% from 2021 to 2023. Even after a later pullback in rates and prices, the modeled payment remained $1,040 or 77% above the 2021 level. At the same time, inflation changed every budget surrounding the mortgage. Consumer prices rose 7% in 2021, 6.5% in 2022, 3.4% in 2023, 2.9% in 2024, and 2.7% in 2025, measured December to December. Compounded, that is roughly a 24. 5% rise in the general price level from December 2020 to December 2025. In June 2026, CPI was still 3.5% above a year earlier. Inflation slowing does not mean prices return to 2020. It means they are rising more slowly. A household can therefore face a larger mortgage payment while food, energy, repairs, insurance, and other expenses also consume more dollars. There is another force: mortgage lock-in. Millions of owners refinanced or bought at much lower rates. Heffa estimated that the lock-in effect prevented about 1.72 million home sales from the second quarter of 2022 through the second quarter of 2024. Owners hesitate to exchange a 3% mortgage for something near 6% or 7%. Fewer homes for sale can support prices even when higher rates weaken demand. This is the paradox of the current market. High rates reduce what buyers can afford, yet the same rates can discourage owners from listing, limiting supply. So what created the affordability squeeze? First, inflation and the interest rate response. When inflation accelerated, financial markets demanded higher yields, monetary policy tightened, and mortgage rates rose sharply. Mortgage rates also move with expectations about future inflation, growth, and bond supply. That is why a single Federal Reserve announcement cannot guarantee a matching mortgage rate move. Second, supply. America did not enter this period with unlimited housing in the places people wanted to live. Construction constraints, land and permitting limits, labor and material costs, and the lock-in effect all restrict how quickly listings can respond. Third, insurance and climate exposure. Higher rebuilding costs, severe weather losses, reinsurance pricing, and concentrated local risk can affect premiums and availability. This pressure is uneven. Two similar homes in different zip codes may have radically different insurance economics. Fourth, taxes and local assessments. A sale, a reassessment, a changing tax rate, or the end of an exemption can change a homeowner's bill. The previous owner's property tax is therefore not always a safe estimate of yours. And fifth, human behavior. Buyers naturally anchor on the listing price and the lender's headline rate, but a low advertised rate may require points. A temporary buy-down may expire. A smaller down payment may trigger mortgage insurance. A beautiful condo may carry an HOA budget with future assessments. None of these facts means buying is always wrong. It means affordable must be calculated from the full system, not one attractive number. The solution is not to predict the perfect rate. It is to build a purchase that can survive imperfect conditions. Move 1. Compare at least 3 lenders using loan estimates issued for the same loan scenario and on the same day. CFPB says shopping with multiple loan estimates can save roughly $600 to $1,200 a year. Compare interest rate, APR, points, lender credits, mortgage insurance, cash to close, and the 5-year cost, not just the monthly payment. Move 2. Ask for the 0-point option. Points can lower the rate, but they require cash up front. Divide the extra upfront cost by the monthly savings to estimate the break-even month. If you may sell or refinance before that month, the points may not repay themselves. Use your actual quote. There is no universal winner. Move 3. Price insurance before the offer becomes hard to escape. Give the insurer the real address, roof age, construction details, claims information if available, desired deductible, and any flood or wind exposure. Compare coverage and exclusions, not only premium. If flood risk matters, request a separate flood quote. Move 4. Rebuild the payment from the bottom up. Start with principal and interest. Add a realistic property tax estimate for you, not the seller. Add insurance, mortgage insurance, HOA, utilities, and a repair reserve. Then stress test the total. What happens if taxes or insurance rise, an appliance fails, or income dips? Move 5. Read the documents in sequence. Use the loan estimate to compare offers. Use the closing disclosure, which generally must arrive at least 3 business days before closing, to check whether the rate, loan type, cash to close, fees, taxes, insurance, and credits match what you expected. Ask about unexplained changes before signing. Move 6. Treat a temporary buy-down as temporary. Qualify your own budget at the full future payment, not only the discounted first-year number. Put the date and amount of every payment step on your calendar before closing. Move 7, create a PME exit file. Keep the original value, amortization schedule, payment history, and servicer rules. For eligible conventional loans, ask what is required to request cancellation at 80% of original value. Do not assume rising market value alone creates an automatic right under every loan or investor rule. Move 8. Use extra principal strategically. Confirm there is no prepayment penalty and that extra money is applied to principal. Extra payments can shorten the loan and reduce interest, but paying down a mortgage is not automatically smarter than keeping an emergency fund or paying higher rate debt. Liquidity has value when a roof, job, or insurance deductible surprises you. Move 9. Calculate a refinance break even before celebrating a lower rate. Add lender fees, title costs, appraisal, and any points. Subtract genuine credits. Divide the net cost by monthly savings. Then ask whether you expect to keep that loan past the break-even month. A lower payment can still be an expensive transaction. Move 10. Check assistance and loan options without assuming the smallest down payment is cheapest. Compare conventional, FA, VA if eligible, USDA if eligible, and verified state or local programs. Examine mortgage insurance, upfront fees, property requirements, rate, cash needed, and long-term cost. Assistance can solve a cash problem, but every program has rules and trade-offs. The smartest mortgage is not necessarily the one with the lowest payment today. It is the one whose total cost you understand, whose risks you can carry, and whose structure still works when life refuses to follow the spreadsheet. The hidden cost of an American mortgage is not one secret fee. It is the distance between the payment people see and the full cost of carrying the home. In 2026, record national prices, mortgage rates near the mid-sixes, accumulated inflation, insurance pressure, and limited supply have made that distance wider and more important to measure. So remember the 5 checks. Compare multiple loan estimates, calculate the all-in payment, quote insurance early, inspect escrow and MI rules, and demand a break-even calculation before paying points or refinancing. If you are buying or already own a home, which cost surprised you most, interest, insurance, taxes, closing costs, or maintenance, share your experience below. It may help the next person see the bill before the bill sees them. This is Business Decoded, where the number on the surface is only the beginning.